Hello everyone, welcome to Just Invest Today. And today we're going to be talking about the most important Warren Buffett article in my opinion. Guys, if you're a true value investor, you need to read this article. It puts everything just very simply and just nicely. And this is exactly what you need to become a strong, long-lasting value investor in this game. So let's get into this video. Let's read this article together. I probably won't read all of it, but I'm going to read the most important parts to me. So let's get into it. So Buffett's annual letter. What can you learn from my real estate investments? So this is the best quote too. Investment is most intelligent when it's business-like. Benjamin Graham, the intelligent investor. So when you look at investing like it's a business, that's when it's the most intelligent, and that's when you can understand what's going on. You're not looking at it as just a stock. You're looking at it as you're a part owner. You're a part of the business. So that was Benjamin Graham. So let's get into it. It is fitting to have Benjamin Graham quote open this essay because I owe so much of what I know about investing to him. Guys, remember, this is written by Warren Buffett himself. I will talk more about Ben in a bit later, and I will even sooner talk about common stocks. But let me first tell you about two small non-stock investments that I made long ago. Though neither changed my net worth by much, they are instructive. This tale begins in Nebraska. From 1973 to 1981, in the Midwest experienced explosion in farm prices caused by a widespread belief that a runaway inflation was coming and fueled by lending policies of small rural banks. Oh, inflation, guys. Is this a little quote, or is this a little hint at what might come? Who knows? Then the bubble burst, bringing prices declines of 50% or more that devastated both leveraged farmers and their lenders. 5 times as many Iowa and Nebraska banks failed in the bubble's aftermath as in our recent Great Recession. In 1986, I purchased a 400-acre farm located 50 miles north of Omaha from the FDIC. It cost me $280,000, considerably less than what failed bank had lent against the farm a few years earlier. So guys, Warren Buffett waited for an opportunity. He waited for an opportunity. He's seen the opportunity, and he just pounced on it. But I knew nothing about. Cause that's what I felt. I knew nothing about the operating farm, but I have a son who loves farming, and I learned from him both how many bushels and corn and soybeans the farm would produce, and what the operating expense would be. From these estimates, I calculated a normalized return from the farm to then be about 10%. And I almost thought it was like productivity would improve over time and that crop prices would move higher as well. Both expectations proved out. So just right here, Warren Buffett seen an opportunity. He's seen the depressed prices. Just think of this as like stocks. He's seen depressed prices. He pounced on it when he's seen a good annual return of at least 10%, and he knew there was a limited downside, guys. It's a farm. It's not going to go away. The productivity of the farm is just going to keep growing and growing and growing over time, so he doesn't have to worry about it. And then this is the next lesson. I needed no unusual knowledge or intelligence to conclude that the investment had no downside potential and had substantial upside. There would, of course, be occasional bad crop. Prices would sometimes disappoint, but so what? There would be some unusual good years and as well, and I would never be under any pressure to sell the property. Now, 28 years later, the farm has tripled its earnings and is worth 5 times as more what I paid, and I still know nothing about farming, and recently made just my second visit to the farm. So guys, do you know any businesses that you can really do that? You can just invest and just kind of let it go, leave it alone. You know this isn't going to be some huge downside coming along, and you know 5 years from now you're guaranteed to have a more productive business. Just think of businesses that you know like that. Like right now, that what comes to my mind is Amazon. Like, what's the huge downside of Amazon? Maybe what can be the huge downside of Amazon? Like, it's going to be more productive, better 5 years from now. So the only thing that you're really worried about is a reasonable price and the antitrust law. So you got to worry about that a little bit. So let's continue. In 1993, I made another small investment. Larry Silverstein, Solomon's landlord when I was a company CEO, told me about a New York retail property adjacent to a New York university that the Resolution Trust Corp was selling. Again, a bubble had popped, this one involving commercial real estate, and the RTC had been created to dispose of the assets of failed saving institutions whose optimistic lending practices had fueled the folly. So again, another bet, another 10% bet that he was making, and there was no downside. It was property. New York, he knew New York property was going to increase no matter what. It was going to go up. So he made that decreased bet. He knew he was going to get at least a 10% annualized bet. So he bought at a reasonable place. He made sure he focused on his downside. He was just thinking, what could the worst thing be that can happen to a New York City property? Not much. It's going to increase in price. 5 years, 7 years, 8 years, 10 years, whatever it is, he knows it's going to increase in price. The rents are going to increase over time. Income from both the farm and the New York real estate will probably increase decades to come. Though the gains won't be dramatic, the two investments will be solid and satisfactory holding for my lifetime and subsequently for my children and grandchildren. I tell these tales to illustrate certain fundamentals of investing. You don't need to be an expert in order to achieve satisfactory investment returns, but if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple, don't swing for the fences. When promised quick profits, respond with quick no. Guys, jump over 1 foot bars, don't jump over 7 foot bars. Simple investments. Focus on the future productivity of the asset you're considering. If you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. Guys, Charlie Munger says this all the time. Just put the business in your too hard pile. It's okay to say no. There's no time limit. You can take years to make your investment. 3, 4, it doesn't matter. Just be patient and wait for the opportunity. If you instead focus on your prospective price change of a contemplated purchase, you are speculating. There is nothing improper about that. I know, however, that I'm unable to speculate successfully, and I'm skeptical of those who claim sustained success at doing so. Half of all coin flippers will win the first toss. None of those victims has an exception of profit if he continues to play the game. With my 2 small investments, I thought only of what the properties would produce and cared not at all about the daily valuations, guys. We do not care about stocks, the daily valuations that go up and down. Who cares? Games are won by players who focus on the playing field. I love this line. Games are won by players who focus on the playing field, not by those eyes that are glued to the scoreboard. If you can enjoy Saturdays and Sundays without looking at the stock prices, give it a try on weekdays. So guys, he's just basically saying, focus on the businesses. Don't focus on where that stock price is moving up and down. Like, that's not important. Just focus on how productive is the business getting. Forming macro opinions or listening to the macro or micro or market predictions of others is a waste of time. Indeed, it's dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I am reminded of Mickey Mantle's scathing comment. You don't know how easy the game is until you get into the broadcasting booth. My 2 purchases made in 1986 and 1993, what the economy, the interest rates, or the stock market might do in the years immediately following 1987 and 1994 was no importance to me in determining the success of those investments. I can't remember what the headline or the pundits were saying at the time. Whatever the chatter, corn would keep growing in Nebraska and students would flock to New York City. So guys, this is exactly what's happening in the market. Everyone's talking about interest rates, everyone's talking about what the government's doing, Russia, China, whatever is happening in the market, commodity prices. Warren didn't care. He just focused on the business, focused on what the business was going to do in the future, and just made an investment if it was a reasonable price. Then he talks about Mr. Market. We know all about Mr. Market and what's that about. Those people who can sit quietly for decades when they own a farm or apartment house too often become frantic when they are exposed to a stream of stock quotations and accompanying comment is delivering an implied message of don't just sit there, do something. For these investors, liquidity is transformed from an unqualified benefit it should be to a curse. The flash crash of extreme market fluctuations can't hurt an investor any more than an erratic, mouthy neighbor who can hurt my farm investment. Indeed, tumbling markets can be helpful to the true investor. If he has a crash available, prices get far out of line with values. A climate of fear is your friend when investing. Euphoric world is your enemy. And guys, this is so true. Warren Buffett says this all the time. Like, people who buy, if you're a net buyer of something, say if you go to the grocery store all the time, you're a net buyer of groceries. You're always going to be happy when the prices go down, right? But when prices go up, you're going to be unhappy, you're not going to be mad because you're a net buyer of groceries. You're going to keep buying groceries every week. That's how Warren Buffett thinks about the stock market. He's a net buyer of stocks. He is happy when stocks keep going down and down and down because he's getting them at a cheaper price, just like the grocery. He's going to be mad when prices go up because now he has to pay more for what he wants. So that's how you got to think of the market. During the extraordinary financial panic that occurred in 2008, I never gave a thought of selling my farm or New York real estate, even though a severe recession was clearly brewing. And if I had owned 100% of a solid business with good long-term prospects, it would have been foolish for me to even consider dumping it. So why would I have sold my stocks that were small participations in wonderful businesses? True, any one of them might eventually disappoint, but as a group, they were certain to do well. Could anyone really believe the earth was going to swallow up incredible productive assets, unlimited human ingenuity existing in America? That's what happens all the time. When people see a crash coming, they just sell their amazing businesses that make no sense. These businesses are going to be better 10 years from now. That 1 or 2 years of a market crash, if you think longer, 5, 10 years, if you have a really strong business, it won't make a difference. Those are going to go back to their original prices. You wouldn't sell, like, if there was a market crash and you owned real estate, would you sell your house even though you're still getting rent? It's still productive, it's still making you money. You wouldn't sell that house, right? Or that apartment or the condo. You would just keep having it. So when Charlie and I buy stocks, which we think as the small portions of businesses, our analysis is very similar to that which we use in buying entire businesses. We first have to decide whether we can sensibly estimate earnings range for 5 to 10 years out or more. If the answer is yes, we will buy the stock or business if it sells at a reasonable price in relation to the bottom boundary of our estimate. If, however, we lack ability to estimate future earnings, which is usually the case, we simply move on in other prospects. In the 54 years we have worked together, we have never forgone an attractive purchase because of micro or political environment or the views of other people. In fact, these subjects never come up when we make decisions. It's vital, however, that we recognize the parameter of our circular competence and state what was inside of it. Even then, we will make some mistakes, both with stocks and businesses, but they will not be the disasters that occur, for example, when long rising market induces purchases that are based on anticipated price behavior and desire to where the action is. And guys, and to end it right here, these are the ending paragraphs I want to read. If the investors frantically bought and sold farmland to one another, neither the yields nor the prices of their crops would be increased. The only consequence of such behavior would be decreases in the overall earnings realized by the farm-owning population because of substantial costs it would incur as it sought advice and switched properties. Guys, can you just imagine that? Like, when you put it in these terms, like, would you buy and sell farmland? Like, think of these stocks as businesses. Would you just keep buying and selling and buying and selling, keep trading hands? The only people that are going to benefit are the people helping you with the purchase and with the selling. You're not going to be making the profit if you're continuously doing that. They're the ones taking all the money from you. So those are the banks, the advisors, all those people, the people trying to get you to sell and buy a lot of stuff. So nevertheless, both individuals and institutions will constantly be urged to be active by those who profit from giving advice or affecting transactions. The resulting frictional costs can be huge, and for investors in aggregate, devoid of benefit. So ignore the chatter, keep your costs minimal, invest in stocks as you would in a farm. So guys, that is it. This article is amazing. It basically breaks out all of investing in this one article. You don't need to know anything more. This is everything you need to know. How to value a business, how to look at the stock market, and how to look at your businesses and look at them as what they are. So guys, man, if you want to read the rest of the article, I'm going to link down below. But guys, this is the best article for investing by Warren Buffett himself. Guys, if you like this video, like it, subscribe to my channel. Get back to you in the next video. Peace.